promised, today on this edition of Commodity Classroom, we will talk about various ways in which you can invest in commodities. You can either physically own commodities, say purchasing gold or silver in the form of jewelry, coins or bullions, or you can invest in commodities through futures, mutual funds and exchange traded funds. To discuss all this and more, we now have Mr. Anuj Gupta, Head of Commodity and Currency at HDFC Securities, now joining us. Mr. Gupta, thank you so much for taking your time out and speaking with us here on ET Now. First up, help us understand what are the different ways of investing in commodities. For instance, if we say want to invest in precious metals like gold or silver by physically purchasing it, but what are the other ways in which we can invest in other commodities, especially say Brent crude or soft commodities, and what is the most preferred mode of them all?
As commodities are linked with the physical market, so physical option is there. But as well as concern about the trading part and the online trading part, we have the online exchanges where you can trade online by using the broker's app or the exchange platform. So just like equity market, we have MCX and NCDX, two exchanges which are providing the facility to trade in commodity market. So as far as concern about the international market, MCX is there where we can trade in international commodities just like bullions, gold, silver, base metal, copper, zinc, lead, aluminum, and energy part where we have two energy product. One is crude oil and second one is natural gas. So these are the international commodities which are available to trade on the exchange MCX, and we can use or we can choose the broker to trade on the MCX platform just like equity market.
And since we spoke about investing in precious metals, what are the advantages of investing in precious metals via, say, ETF or sovereign gold bonds rather than physically purchasing them?
See, if we talk about the bullion market, there are two, three ways where investor can invest in the bullion prices. One is definitely the physical market. The second one is the traders who want to trade or who want to track commodities or who want to trade the volatility of the bullions. They can choose MCX where they can trade in commodities in the futures market. Even we have seen that many jewelers are using the MCX platform to hedge the portfolio or to hedge the physical delivery. So MCX is basically used by the jewelers or the traders who want to trade the volatility, daily volatility of the commodity market. And the second one is the ETF, where if you want to invest in SIP form, where the small investor want to invest in the gold, they are choosing the gold ETF. So ETF is basically the backed by the physical gold, where the prices of the ETF are moving as per the physical gold movement. So there are the three ways: physical, gold futures, and the gold ETF. These are the three ways where investor can go for investment in the gold market. But we have also seen a few days back the gold sovereign gold bond, but still it is not there. But a sovereign gold bond is also the one of the way where investor can invest in gold for the longer term perspective, just like 5 year to 7 year. But right now we have three phases where three ways where investor can choose gold as per their requirement or as per their investment opportunity.
And Mr. Gupta, since you spoke about sovereign gold bonds, help us understand how attractive are those and what are the benefits of investing in gold through sovereign gold bonds versus other methods?
See, sovereign gold bond gave a very good return. We have seen that they gave more than 120% kind of return since the inception. So they are performing well, and we have seen the traction towards the sovereign gold bonds are increasing by the small investor, where they can invest gold with 1 gram to 400 grams. So this is the where we have seen the investor are using the sovereign gold bond to invest. One, the important thing is that government is giving 2.50% guaranteed return on sovereign gold bond. That also attract the investor to invest in the sovereign gold bond, and this is backed by the Reserve Bank of India. So this is a government backed by the government. So every investor or small investor who want to invest in gold, they are choosing the sovereign gold bond. And even this is backed by the RBI, so there is a guaranteed return. So that this product was very attractive among the investor. But right now, we have seen there is a no tranche available to invest in sovereign gold bond. So people are shifting their fund from sovereign gold bond, or they are choosing a gold ETF to investment.
And Mr. Gupta, ETFs versus mutual funds, what is the cost and return differential between the two? Help us understand.
Mutual fund and ETF are both run by the AMCs, but as far as concern about the ETF, so there is a low cost product where investors may get better return as compared to the mutual fund. But definitely both products are for the long term perspective. ETF are basically, if we talk about the commodity ETF, these are the product where investor can choose the SIP form. They can invest or they can choose a commodity ETF to invest in every month. They can choose a SIP form to invest in the ETF. And if somebody wants to keep this ETF in a demat form, or they can transfer to some other, or if they want to gift some other, so they can choose the gold ETF or commodity ETF. So commodity ETF basically electronic form to keep the commodities in electronic form in their demat account. So basically, as for the concern about the costing, there is a low cost product where investor can get better return as compared to the mutual funds.
And Mr. Gupta, what are the charges that exchanges charge for trading in commodities through exchanges, that is MCX and NCDEX? Is it at par with equity or higher or lower as compared to equity?
See, as far as concerned about the costing part, somehow these are a little bit lower than the equity market, because there is only the turnover charges, there is only the STT and the CTT commodity transactions. So as compared, if you see, there is little bit lower than the equity market. But yes, volatility is there, so there is a concern that these products are globally attached with the global market. So volatility is there. So, but the costing as compared to the equity market is lower than the equity market.
Mr. Gupta, thank you so much for taking your time out and speaking with us here on ET Now. Let's shift focus to our next segment, Did You Know? And today we will put the spotlight on the world's first exchange. And the world's first futures exchange, the Egg and Butter Board, was established in 1848 as a subsidiary of the Chicago Produce Exchange. It was restructured as the Chicago Mercantile Exchange in 1919, as was dominated primarily by agricultural commodities until the creation of bond futures contracts in 1970s. That's all the time we have on this edition of Commodity Central, but you don't go anywhere. Stay tuned to ET Now.
If you like this video, then like, share and subscribe to ET Now.